Hello again. Been about a month since I made a video, so sorry about that. But I'm back. I don't have too much going on. I've just been trading my trend following methods. So I've been trading this price slope method on a dynamically allocated portfolio of sector ETFs. So the idea is just to trend follow the sector ETFs that are hot and stay out of the ones that are not hot. I basically just fit a straight line to the price for a number of days in the past to get a line slope. If that line slope is positive, I go long. So I started about 3 months ago with $14,000, but sadly we've come to the end of the line. My wife asked me rhetorically where we could find cash to fund some home renovations. I think she knew very well where she could find about $15,000 in cash. So I sold my sector ETFs for 13, and I found another 2,000 in my Robinhood account. So I guess most people use a home equity line or even credit cards for this kind of home renovations, but out of prudence, we've been funding this one out of cash. So here's about 3 months of performance data. The blue curve is my sector ETF portfolio. The red curve is a SPY. Over those 3 months, the SPY is down over 9%, while I'm only down 6.6%. So you'll notice that my account has far less volatility day to day than the SPY. It's a little counterintuitive. It's kind of surprising that you would get less volatility in a portfolio that has fewer stocks, but it seems to be the case, and I think it means the method works. But one caveat is, at any given time, I'm also holding cash, which is going to reduce the volatility relative to the SPY, where you're allocated 100%. So here I plot my daily allocations for 3 months. It's shown in a cumulative area plot. So the big red area is cash. And you can see that at any given time, I'm anywhere from 0% to 75% cash, depending on market conditions. So here I've circled a period where the markets were rising. So over that period, the SPY was up by 11%, while I was only up by 7%. So initially, I was only in a few positions, but as the signals went active, I was nearly in all the stocks with zero cash allocated. So during the time when I was fully allocated, my performance basically mirrored the SPY, and it makes sense if you're equally invested in all 11 sector ETFs, and you would expect to have a similar portfolio to the SPY, though the allocations will be slightly different. So here I've circled the last few weeks, which have been terrible weeks for stocks. So in this case, the situation is mirrored. The SPY lost 11%, while I only lost 7%. So I was only in several positions during this time, and I varied the allocations to keep my cash level down. I wanted to stay invested, just invested in the right things. But when I closed the account, I was barely in anything. There were essentially no active signals a few days ago when I closed the account. And that makes sense because during times of sort of panic, all assets like to march downward in lockstep, everything except for cash. So wrapping up the video, let's return to the performance slide. I really regret having to close the account during this, quote, interesting time, because I was going to see how the method performed through a real drawdown. It looks real promising. That's obvious. It's not falling nearly as much as the SPY. I wanted to trade it for at least a year. And when I closed the account, I was ahead of the SPY. So when the SPY had a big climb, I rose in lockstep, except for the first few days when the signals were still going active. When the SPY was declining, I was only in a few positions and carried a lot of cash. So I can tentatively say that there appears to be an edge here. It's keeping me in the market when I should be, and out of most parts of the market when I should be as well. There's a couple of caveats here that are going to suppress the real returns of this method. The first is capital gains. You're going to pay if you're in and out of these stocks on a daily basis. You're going to be paying short-term capital gains on everything. Presumably, if you just bought and held the SPY, you would be paying long-term capital gains, and that can be a big difference. The second is dividends. So these sector ETFs pay dividends, but unless you're a shareholder on X dividend day, you're not going to collect that dividend. So that's definitely a headwind. Over the course of a year, you'd probably lose I don't know, 1 to 2% of non-captured dividends. So, the slope price slope method has to outperform just to, in simple terms, just to break even with the SPY. Still, I think the method looks really promising, and I may end up converting my small cap trend following account into this sector ETF method. It seems like a pretty prudent way to manage it. If you're self-managing money, you've got a retirement portfolio, it would make sense to kind of stay. I don't know. It's a good method. It's trying to stay out of trouble, basically. So anyway, let me know what you think in the comments. Love to hear your comments as always. And if not, see you in the next video.